Hello, so we are on chapter 12, which is going to be a continuation of what we've done in 9, 10, and 11. So remember, we're dealing with merchandise company. Last semester, we had a lot of service industry. So this may feel like it's repetitive, but since we have those new accounts for sales and cost of goods sold and purchases, all that from 9 and 10, our financial statements and our closing entries are going to change a little bit. So you can see we're going to do some financial statements and expand our knowledge base. So the first part is it talks about the income statement. And we used to come in and say, let me see if I can get this working over here today. We used to come in and kind of have a basic income statement. Oh, I don't want red. Let's go with blue. So we would say revenue. Ooh, that was a big R. Minus expenses gave us net income or net loss, right? So now, as you can see, we come down here and we're expanding upon our income statement. Now, instead of just revenue, we're going to call it net sales. So you got to remember what makes up net sales from last chapter. So let's do this. So we're going to come in and say net sales is sales minus sales returns and allowances minus sales discounts. I'm not writing very well today. So that makes up your net sales. Then we come in, we're going to subtract our cost of goods sold, and it gives us what is called gross profit. So we had this a little bit last chapter, and then we come in and subtract out our operating expenses, and that gives us net income from operations. Now that is key right there, from operations, because we're going to have, whoa, that was a bad highlight. We're going to have these other items coming in, and it's going to be other income and other expenses. So when we talk about these other income and other expenses, they're not necessarily tied to the general operations of the day-to-day business. What are we in business to do? These are going to be things that usually come in, and let's highlight these a different color. Let's do green. We're going to say these areas right here are usually interest. So it may be interest income or interest expense, and it ties back to usually some type of investments. Now, it could be something totally different, but you just got to remember it's not tied to the normal operations of the business. So let's clear that so we can move on. So they talk about these in the next couple pages, gives you some information. They give you those coaching tips with the formulas on the side. Oh, and we get this, I'm not a fan of the crooked pages, sideways pages, but they're trying to show you some of those adjustments that we had from last chapter. So they talk about in here, how do you find your cost of goods sold? There is a general outline that I usually give students. And it was on the review for last test, but usually you're going to take your beginning inventory and you're going to add in what they're going to call net purchases, and they give you that formula there. So I usually just call it purchases. And that gives us what is called available for sale. Then we go in, oh, I totally misspelled sale. Let me erase that. That was not good. I don't know what I was thinking. I'm concentrating on trying to write with this thing I've got here. Okay, so let's go in and do sale. Okay, so available for sale, and then we subtract out ending inventory. Let me put a V up here for that one. So subtract out ending inventory, and that gives us what I call cost of goods sold. So they essentially kind of give you that same outline here. They're saying you have your net purchases, net cost of purchases, so they're doing net purchases plus freight. That gives you cost of goods available for sale, the beginning inventory plus net cost. Then you go in and find cost of goods sold, which is cost of goods available minus ending inventory. For some reason, seeing it this way, and maybe if you rewrite it in a little bit better, this is kind of chicken scratch here, but seeing it in this type of format sometimes clicks better than seeing this. So the only thing you got to remember, this, what they're telling you with these net purchases, is for periodic. So you may have to remember, how do I calculate purchases? So that would be purchases minus purchase returns and allowances minus purchase discount plus freight in. I'm running out of room, freight in. So all of that is for periodic. When you come in and do perpetual, under perpetual, that is going to be just the inventory change. How much did they buy in purchases? How much did inventory increase? I don't know if you guys know math, but a triangle represents delta, which means change. So for perpetual, they'll have an idea and they'll tell you how much was purchases over the period. But for periodic, you're going to have to calculate out those net purchases to get this formula. Your gross profit, back on the other page they gave us, that is just sales minus cost of goods sold. That gives you your gross profit. Okay, I'm going to clear this because I'm going to draw and it's all going to follow with us. Okay, then we come into these operating expenses. So now we are going to break operating expenses out into two categories. It's going to be selling and administrative. So the way I tell students to think about this is selling expenses relate to selling the product that you have on your shelves, whatever you're trying to get rid of. So whatever ties to making that sale. That's why delivery expense is in there, advertising's in there, depreciation for store equipment, possibly some insurance expense if it's related to the store, or insurance on the delivery truck, that type of thing. There is some insurance that goes under administrative, so you just have to watch the wording that they have in the problem. So all of these would be tied to the sale of whatever product we have. Now, administrative is more of like, think of your corporate office or your managers, the people that are just making sure the business is still running. So they've got rent, office salaries, your utilities, office supplies, depreciation on office equipment. All of that is administrative. So we break out our expenses into these two categories. Then they come in and talk about other income. And they're going to give you their formal definition, but like I said, usually it's related to interest. So interest that they receive would be other income. Interest that they paid out would be other expense. Now they're saying interest on money they borrowed that's not tied to up here in these general operating expenses. We have 3 financial statements. Remember that, let's talk about those over here while we're on this page. And they're prepared in a certain order. You guys remember what you have to do, what they are? So the first one is income statement. And that's what we were just talking about, right? Those different categories, and we come out. Once we get our income statement, it flows into the second statement, and that is statement of owners. I'm having a hard time writing today. Equity. or you may hear me call it retained earnings statement because that's what we do it on the corporate side in the academic class, but they're both the same thing. If you hear me slip up and say retained earnings, mean the same thing. And then what we get on the statement of owner's equity flows into the balance sheet. Okay, so when we talked about categories, I don't know if you guys remember, I said there were like, whoa, that was bad. There were 5 main categories that we had when we first learned about accounts and chart of accounts and all that. We first came in and said assets. Assets are usually our ones. Those account numbers will start with a 1. Then we come in and have liabilities. Then we come in and have owners. Can't spell. Equity. And then we come in and have revenue. And then we have 5 that is expenses. Okay. So on our income statement, our 4s and 5s go to our income statement, and we come up with net income or net loss, right? Then that is what flows into owner's equity. So in owner's equity, on that statement, we have a basic formula. We're going to take our capital at the beginning. We're going to add any investments to capital. So were there any increases to the capital account? We are going to add or subtract net income / net loss. So that's about N, net loss. If it's net income, you add it. If it's net loss, you subtract it. And then we subtract out any draws, any money that the owner took out, and that gives us ending capital. So then our ending capital flows over to the balance sheet. So what's left on the balance sheet? Our 1s and 2s flow down to the balance sheet, and this ending capital represents our equity. So remember our equation, assets equal liability plus equity. So that ending capital is your equity, and then you find your numbers for your assets and your liabilities, and that goes into your balance sheet. Okay, so hopefully we remember all of that. And let's see what's on the next page. I think they're going to go into the statement of owner's equity. So they show you a little bit of that there. Not much. They just kind of show you the beginning, net income, less withdrawals, whatever increase in capital. They kind of have it in a different order than I did, but it still works the same. And then they got that ending balance. And then we talk about the balance sheet. Now, our balance sheet is going to be broken out into new areas. And we're going to have what's called an expanded balance sheet. So we come in and normally our equation is assets equal liabilities plus equity, right? So now our assets is going to be divided into categories. We're going to have current assets. I abbreviate that IA, so you can see right there what current assets are. They are going to be converted within 1 year. That's the key for current assets, 1 year versus what they call long-term assets. So we have current assets, and then there's 3 names you can call them. You can call it PPE for property, plant, and equipment, and that's kind of what they say. Oh, that was really bad. Sorry, guys. That's what they say down here. I was trying to get there. Got wild. Okay, so PPE is what they say down here. They just call it plant and equipment, but it could be property, plant, and equipment. It can also be called long-term assets or fixed assets. You will hear me end up saying fixed assets a lot. That's just kind of the term I've reverted to, but it can be any of those names. And they all mean the same thing. So it looks like your book's going to call it property, plant, and equipment, which is fine. these are things that are going to be used usually longer than 1 year. So think of it like your store cases, your display cases, if you bought your building, if you have a delivery truck, all those things are going to last or be around for longer than 1 year. So then we also come in and we're going to have what's called current liabilities and long-term liabilities. Let's get to that page so you can see that. Same thing with the breakout. You have a 1 year period or longer than 1 year. So current liabilities, and I'll abbreviate those CL, current liabilities, and then long-term liabilities. I usually don't have an abbreviation for them. I guess I could start calling them LL, but anyway, long-term liabilities are usually your notes payable or your mortgage payable, things like that that are going to be longer than 1 year. So we break our categories out. We don't have a category breakout for capital. Just our assets and our liabilities are going to be current versus long-term. I think you guys remember about journal entries and how to post them in that worksheet. Adjusting entries, we did that last chapter. Let's see what else. Closing entries. Oh joy, I don't know if we remember that. I think I talked about it briefly. So our closing entries, what we learned about, and I think it was like chapter 5, is we had 4 closing entries. So the first one was close out revenue to income summary. All right, so we close out revenue to income summary. Then our second one is going to come in and close out expenses to income summary. All right, then our third entry, I don't know if you guys remember, but I would always say at this point, go make you a T account, because up here, when we close out revenue, revenue has a normal credit balance, right? So to close it out, we would have to debit revenue, and we would end up crediting income summary. So you're going to have some number over here that ties back to entry 1. And then over here, expenses have a normal debit balance. So to close those out, you would have to credit them, and therefore you would debit. This is supposed to be credit up here. Oh, bad ease. I can't even erase. Let's erase that. Okay, so let's try this again. So this would be a credit. There we go. All right, so if we debit revenue and we credit income summary, then our first entry is a credit on the income summary side. We credit expenses, debit income summary. So our second, so that's from entry 2 and that's from entry 1 for income summary account. You got to find the balance, right? So if it is net income on your income statement, your 1 should be larger than your 2, right? The credit side should be larger than the debit side, and you would subtract those 2. And I'm going to put NI over here. So your balance would be the net income, and it would be on the credit side. Now, if you did this for income summary and your debit was bigger than your credit, that would mean your balance would be on the debit side, and that would represent a net loss. So I don't know if you guys remember me talking about that, but you got to figure out which side is the balance. So usually we have net income, and usually there is a credit balance. So to get rid of the credit balance in income summary, we close that out to the capital account. Usually I would call that retained earnings. I think you guys remember me slipping and calling it that. So if income summary has a credit balance, then to capital, or has a credit balance, to get rid of it, we would have to debit it. And therefore we would have to credit our capital, right? And that also makes sense, because in order to increase our capital, we would credit it. So profits end up going over to the capital account. And that's what we usually like to see. Now, if it was a debit balance, then it would be the opposite. We would reduce our capital and we would have to credit the income summary. Then our fourth entry is to close out draws to the capital account. So remember, we have to do all of these entries because our financial statements are just reports, and we have to actually make our accounts show what we did on our reports. So if our draw has a normal debit balance, then to get rid of it, we would have to credit it, right? And we would then debit the capital account, which makes sense because we are reducing our capital, and you reduce capital with a debit. So they're giving you these journal entries here, and they're having you go in and let's see, what are they doing? I think these were the adjusting entries, and then I probably jumped ahead. These look like the adjusting entries. In the next page, let's see what we get over here. Here's the closing entries. So they're telling you to close out all of those amounts, transfer it over to the income summary account, and it goes to capital, just like I did in this little blip right here. So there is your journal entries, and then they didn't give you the actual journal entries that showed you everything, but yeah, should be good. Post-closing trial balance. After we've done our closing journal entries, those 4 entries, then we come in and figure out what is our balance. So what should be left? Assets and liabilities and your ending capital account, because we closed out all of our revenues and expenses. Oh, here's your example. So page 450 is your example of your closing entries. Now, some things that are different here. Purchases. These are contra cost accounts, meaning they do the opposite. So they move them up here because their normal balance is a credit, just like for sales and rental income. Those are revenue accounts. So their normal balance is a credit. Well, the normal balance for these two is also a credit. So to get rid of all the credits, we have to debit them. So that's why they group that together. Then the other thing down here that may throw you guys off is you have these sales returns and allowances and sales discounts. They are contra revenue accounts, meaning their normal balance is a debit. So to get rid of them, you would have to credit them. That's why they group them with all these purchases and expense accounts down here. So don't let that throw you off. They're putting the contra accounts so that it's all one nice entry. In real life, you can mix them up as long as you know what goes where, what the balance should be. Income summary, that's the third journal entry. If you took the difference between this debit and the credit, you can tell the credit is larger. So if we're looking at these two numbers, because what happens is you guys want to look at the capital account and close out the capital. We're not doing that. We're finding the difference between what we just did, the debit and the credit on income summary. And we came out with a balance. So let's do this. If we did a T account for our income summary, we'd have that 96,740 on the credit side, and we'd have 67, what is that, 995. So when you find the difference between those, the credit is larger than the debit. So it would be 13,745. If that balance is on the credit side, to get rid of it, to be able to say our balance is 0, what do you have to do? You have to debit it and put that number, which is what they did down here. That's why they're debiting that account. Every time I have students go in and try to close out the capital account, we're not doing that. We're closing out income summary. We're moving it into capital. Then we come down here and we close out our draw account to the capital account. There's your post-closing trial balance, what's left. These are our assets. And remember, accumulated depreciation is a contra asset, but its normal balance is on the credit side. There's your liabilities, and there's your ending capital. And we're all happy because it's in balance. So I'm not worrying about reversing entries. There's sometimes you have to do those, but I'm not going to stress about that. So you can skip that section of it, of the book. And that's pretty much what we're going to cover for chapter 12. I'll do a separate video for the homework.